Hey there friends, thanks for joining me again, and I have another video in the series on how to buy a house. And this time I have a very important video. Not that the others aren't important, but I really do believe that this is a pretty important one because it's about shopping for a mortgage. How many of us do a lot of research before we buy a car? Or even some furniture? Or maybe even something as simple as a toaster. You know, if we put a lot of effort into shopping around for these types of things, we should put a whole lot more effort into shopping for our mortgage, because shopping for a mortgage, in my opinion, is just as important as shopping for the right house. It can make a big difference on how much we pay at closing and how much we pay over the life of the mortgage. And it can make a big impact on even the payments that we make each month. So I have some suggestions on different ways to make sure that you're going to get the right one to fit your needs. The first thing you're going to want to consider, of course we've already talked about this is just a really quick review, is the length. They come in lengths of about 10, 15, 20, 30, and 40 years, with the most common being 15 and 30 years. And then of course they come in fixed or adjustable rates, but what really helps to determine what of those criteria you want is your goals. So if you just identify your goals, how long do I plan to stay in this house? You build up equity rather quickly, or if you have a goal to pay it off. But identifying your goals can definitely help make sure that you're choosing the right criteria for your mortgage. Once you've identified that sort of stuff, your goals and what you were hoping to achieve in your house, you're going to want to figure out who you want to go through. There are three main choices here, of course. There's brokers, there's banks, and there's credit unions. Brokers are the choice that a lot of people made before the housing crisis because they were able to make some mortgages that may have otherwise not been able to happen. So say there were two people who wanted to be on the mortgage, one person had a good credit score, the other person did not. That sort of thing can mess up things when you try to go through a bank, but a broker can pull more strings sometimes. So they, pushed through all sorts of mortgages. Sometimes they were even found out for having falsified information, and then when the mortgages were sold to, investors and whatnot, they were found out that these people should never have had these mortgages because they really didn't qualify. Yes, so they took a lot of the blame for the housing crisis that occurred, back in, 2008, 2009. So nowadays, brokers definitely have a little bit better of a reputation, though, because there's been a lot of reform and a whole lot more rules that they have to abide by now. And so they're a better choice than they used to be, let's put it that way. But yes, they are a choice. Banks tend to be the most commonly chosen option because people will just go through whatever bank they normally bank through. And then the last one is through a credit union. The difference between a bank and a credit union, just in case you weren't aware, is that banks are a for-profit organization. So any of the money that bank makes, it gets pushed into the shareholders. It gets divided amongst them. A credit union is a not-for-profit, not to be confused with a non-profit, but a not-for-profit organization, which means the profit that it does make doesn't go to the shareholders, it instead gets rolled back into the customers. So they do this by offering perks, say you have a debit card and they offer you a certain amount of money back on that debit card, like the credit union that I just signed up with offers 10 cents for each time you use your debit card. They can also offer other cool perks that banks can't offer by having like higher interest rates on your interest-bearing accounts, lower interest rates on your mortgages, and even other cool perks like, being able to cover some of the fees and things associated with your mortgage. So out of those three, my choice is actually through the credit union, and you'll see why in a second. So when you decide what type of a institution that you want to go through, the next thing is to just get on the phone and call people, which is not a very fun thing to do. Just to let you know, it can be somewhat tedious. So the first thing you want to ask is whether or not you have to be a customer of that particular institution. Do you have to be a customer of that bank in order to get a loan through them? Do you have to be a customer of that credit union and whatnot? The credit union that I signed up for had a very rigid criteria that you had to fit into in order for them to let you in. You had to either know someone, or you had to live in a certain area, or have your church or volunteer somewhere in the area that was near them. I barely made it. I was just on the other side of the road from where their cutoff was from how close you had to live to them, and they were like, it's all right, we're going to go ahead and do it. Some of the other credit unions were a whole lot easier. It was like, oh, well, anybody in this whole county can sign up or whatnot. So you definitely want to find out if you can be a customer mainly if you're going through a credit union, to find out whether or not you would even qualify. Because if you don't qualify to be there, even if they have really good rates and all this other stuff, it's just not going to matter. So that would be my first question, especially again if you're asking for a credit union, because they tend to be a little more strict. The next thing you're going to want to ask is if they have, or how much their origination, underwriting, or servicing fee is. Those are the three names I mainly encountered that they called them, because I would call and I'd be like, what's your origination fee? And they're like, we don't have one. And then as I'm going through the whole conversation asking about other things, because it's kind of like prying information when they don't want to give it. The thing is that they get a kickback when they get a mortgage, when they push a mortgage through and you are a customer through them. The thing is, they're going to want to push you to be a customer there and make their mortgages sound good, so they're not going to want to tell you the fees. Because if they tell you all their fees, you're going to add it all up and be like, wow, this is expensive, and you'll probably find someone somewhere else cheaper. So I'll ask them, do you have an origination fee? They'll say no, and then as the conversation goes on, they'll say, oh, well, but we do have an underwriting fee. Or they'll be like, okay, do you have an underwriting or origination fee? And they'll be like, no, but then throughout the conversation, they'll eventually admit that they do have a servicing fee, though. So you have to pry, you have to figure out what the price is that they charge you for getting the mortgage through that institution. I have noticed that for the most part, this fee can range anywhere from about $600 to about $1,100 from the companies that I called, which is a big spread. So calling around and finding out how much that fee is can save you at least several $100s. The next thing you're going to want to ask about is other fees. And they're going to moan at this question, but just keep prying. You know, do you have, and it really closely ties to the other video I had, and I don't have that list in front of me, but you know, just other fees with their title, and do they charge for the flood, you know, to find out if you're in a flood zone and all this other stuff. For the other fees, I would highly recommend just looking back at that video and finding out what they were, or just continue asking, what are the other fees? Okay, what else do you have? You know, and when they tell you that, what else? Just keep prying to try and get all of those fees out of them so that you can find out what they are. Add up what the total cost is to find out what it's going to actually cost to get a mortgage through them. The next thing you're going to want to ask is about interest rates. They're going to really moan at this question because it can vary so much depending on what type of loan you want. So you might want to tell them a little bit about what type of mortgage you're getting, whether it's a purchase or if it's a refinance. Is it your first, not first, but is it you're going to be your primary residence, or is it a rental? What does your credit, report look like? About what price range are you looking for? These types of things can better help them pinpoint the interest rate that you're looking for. And of course, it's closely tied to the length too. So remember, the longer lengths tend to have higher interest rates, and the shorter lengths tend to have lower interest rates. So if you tell them, about what length that you're looking for, they'll better be able to answer this question. The next thing you're going to want to ask about those interest rates is whether or not they charge points to get those rates. Some companies charge points, some companies don't, I noticed. And then also a cost if you want to lock it in. This is mainly for the areas where, or in a time when, the interest rates are going up. If you wanted to lock that rate in, sometimes they charge you a fee to be able to do that. Because sometimes they'll tell you it's one rate, and then by the time you close, it's a little bit higher because it's gone up since then. The next thing you're going to want to ask is if they charge prepayment penalties. Most of the time on fixed rate mortgages, they don't charge prepayment penalties, but I've been noticing even more adjustable rate mortgages, they're doing away with these penalties. But I have found there are some institutions that actually do charge prepayment penalties on either a fixed rate or an adjustable rate mortgage. So it's important to ask. The reason you want to ask is in case sometime down the road, say you buy this house, and 3 or 5 years from now you win the lottery and you decide to pay off your house. If you don't have a prepayment penalty, you just owe whatever the balance of the mortgage is plus whatever interest has occurred since that last payment that you've made, and that's it. Well, if they have a prepayment penalty, they say if you pay off the mortgage before the maturity date or whatever, you may have to pay a steep fee. Sometimes it can be pretty high, sometimes it's just a few $1,000s, but still, having to pay extra money just to pay off your mortgage early just isn't fair. So I highly recommend asking about the prepayment penalties and making sure the mortgage that you get doesn't have one. The next thing is to ask whether or not they sell their mortgages. It's very common practice for a company, like a bank, to originate a mortgage, get it through them, and then right after they give you that mortgage, sell that mortgage off to another investor. Honestly, I have had a little bit of good and a little bit of bad experience with this. And, you know, in my family, they've had mortgages and had the same sorts of things. Sometimes they sell the mortgage and it's just the same. Doesn't affect the payment at all. It's no big deal to pay it through the new company and whatnot. And other times it's been worse. I had a family member who sold, their mortgage got sold. And when they did, the new company said, well, we require a escrow account to have a minimum balance. So your payment, you know, your monthly payment has gone up $50 a month, you know. And so he was kind of upset about that because his payment was one thing. Then the company sold off the mortgage and now the payment was higher. And then there was another family member I had whose mortgage got sold and he was current on his mortgage. But then when they sold it, they said he was behind all of a sudden because the payment didn't get, I don't know. It was just, yeah, a mess. So sometimes when they sell mortgages, it can be a bad thing. Sometimes it's not a big deal. Personally, I don't think it's that big of a deal if they sell off the mortgage, but I do ask a secondary question, which is whether or not they service the mortgage. Service the mortgage means if they're still going to be able to have a customer service that can help you when you have an issue with it. So do you, if you wanted to make a payment, do you have the ability to just go into that bank or whatever, that credit union, and make a payment? Sometimes if they sell your mortgage, it's gone. They cannot service that mortgage anymore. You have to make it through the new company. Sometimes they retain the rights to be able to service that mortgage, which means even though they've sold it off, you can still go into their bank and talk to somebody who you're having, if you're having an issue or if you need to make a payment or whatever. So whether or not they service the mortgage may be important to some people, may not be as important to others. If you wanted to just put it on an automatic payment and you don't think you'll ever be walking into an institution to make that payment, it won't be as big of a deal. But if that is something that you think you might need to do, you might want to ask that and make sure that they can still service your mortgage. And then the last thing is going to be down payment required and the other requirements for getting the type of mortgage that you're looking for. They're going to have all kinds of requirements, whether or not, you know, about your income. They're going to have requirements about your employment. Sometimes, you know, they require that you be on a job for at least 2 years or whatever. They can ask different questions about your assets. So different things like what 401k do you have? What kind of real estate holdings do you have? Those types of things. They're going to ask things about your liabilities, whether or not you have things like student loans and your current mortgages now or car payments, that sorts of things. So you definitely want to find out, you know, what kind of stuff they're going to need, what kind of a credit score they require. I did notice as I was calling around, there were some banks that would require a lower credit score for the same mortgage than other banks. So you need to find that out. The other thing would be credit history. Sometimes certain places will say, well, we require no, you know, bankruptcies on the credit report at all. Some will say they can't be within 7 years. Some people say that bankruptcies can't be within 10 years. If you know you have an issue with your credit history, you might want to just go ahead and be upfront with them and say, this is, you know, what I have going on. Would I still qualify? Because again, you're trying to shop around for that mortgage, so you need to find the right company to work with you for the issues that you have too. And then the next thing is once you've decided on which institution, so say you say, okay, I definitely want to go through a credit union, and then you call around to the different credit unions and you find the one that was cheapest, which by the way, when I did this and I was shopping for my mortgage, the credit union that I went through charges no fees. They cover all of the origination, all of the underwriting, all of the service, and many, if not almost all, of the other fees. They cover the title insurance, they cover the title search, they cover the flood, you know, search, all this other stuff. So when I was calling around at some of the other banks and I was adding up their origination fees and other fees, they almost always came pretty close to about $4,000 or $5,000. When I found this credit union that had all these fees that were actually already included, you didn't have to pay anything. They said that they make their money back once you already have a mortgage with them on the interest from you paying on the mortgage. They didn't have to charge any fees. And so I felt like I won the lottery. I was like, wow. So, you know, at the closing table, when we do find the right house, we're going to be able to pay, who knows, pretty close to $4,000 or $5,000 less just by going through and shopping around for my mortgage and finding the right institution to do it through. And they even had good interest rates. So it wasn't even at, you know, there wasn't even an exchange there, meaning a higher interest rate but no fees or anything like that, which sometimes seems to happen. But no, it was a great choice, which is why I really, really liked it. So once you find who you want to go through, the next thing you're going to want to ask is, how do you apply? Sometimes they have to email you an application. Sometimes they want you to do it online. Some people will maybe want you to do it in person, that sort of thing. What they need in order for you to apply. So, what kind of documentation. Sometimes they'll require, pay stubs and other stuff to prove your income. Sometimes they'll just take your word for it for a pre-qualification, but then they will actually, require more paperwork when you actually apply. The cost to apply, sometimes they charge a fee for that if they have to check your credit. Sometimes they'll, charge that right up front. Sometimes they will actually roll that into when you close on a house. Or like my credit union, they don't charge one at all. All right. And then how long it will take. Once you apply, how long will it take before you're actually approved, which is of course important. Really quick though, before you actually apply for your mortgage, make sure you thoroughly shop around for one and that you make sure you found one that you're really happy with. The thing is, when you apply for a mortgage, they're going to pull your credit right away. And if you go through and they're like, oh, well, you could apply and then we'll let you know what the fees are and all this. And then you go to another place and like, oh, well, you can apply and we'll let you know what the fees are and all that. The problem is every time they pull your credit, it gets counted against your credit. So having them pull it just once is no big deal. Sometimes even twice can be no big deal. But once multiple people start pulling your credit, it can actually make your credit score go down. And having a lower credit score can actually make it to where you can't qualify for as good of an interest rate, or you may not even qualify for a mortgage at all. So if you've been struggling with your credit, and making sure you have a nice, good, solid credit score, and then something happens like, oh, well, you're just barely on that line. They require at least a 680 in order to get a credit, in order to get a mortgage. And then, it's like 680 or 685 or something like that. And then multiple people pull your credit. And all of a sudden your credit score is going down, down, down. And now you have, a 670, a 665, something like that. And then you don't even qualify for the mortgage anymore. So I would highly recommend making sure you shop around for your mortgage, pinpoint who it is you want to work for or work through, and then apply for your mortgage so that only one person ends up pulling your credit report. So there you go. That is how you can save thousands of dollars right at closing just by shopping around at the right mortgage. And you can save tons and tons of money over the course of the mortgage by things like getting the right interest rates, because even just 0.25% over the course of a mortgage can add up to tens of thousands of dollars over the life of the entire loan. So that's how I save lots and lots of money when I go to apply for a mortgage and when I close for a mortgage over, of course, the life of the loan and upfront. So hopefully this video was helpful to you on how to shop around for a mortgage. I'm Frugal Green Girl. We'll see you next time.